This is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. I'm Ross Greenwood. It is great to have your company. Coming up on the program, this week the price of Bitcoin and Ethereum collapsed. The US Federal Reserve pumped $125 billion into the US banking system in just 5 days to avert a liquidity crisis. And Tesla shareholders signed off on a potential $1 trillion US pay deal for its major shareholder Elon Musk. So is this the new normal or a sign our markets, our economies are on the precipice? We'll speak with June Bay Liu and Anton Tagliaferro, the fund manager, is here very shortly. Our big banks also have a problem right now. Their expenses, especially for staff and technology, are rising much faster than their revenue, and that means their profits are lower. And that's because Australia's economy simply isn't growing fast enough. And we put all that to the NAB's chief executive, Andrew Irvine, who warns that living standards could decline as a result.
We cannot with confidence say that our children will have a higher quality of life than we did. And that's what this is all about.
And look, a pretty obvious way that Australia could grow faster is to get more resources projects up and running quicker as well. But despite the political rhetoric about wanting to grant approvals quicker, the reality is they're way behind other nations that compete with us for these projects. One person who understands this only too well is Woodside's chief executive, Meg O'Neill.
Our message to government is we've just got to speed things up. It's too difficult to invest here.
And our corporate regulator, ASIC, this week said our market technology has fallen behind the rest of the world. And the competitor to this ASX, Cboe Australia, is up for sale. Well, today we speak with FinClear's chief executive. It deals with all those market makers with its financial technology and infrastructure.
So listing companies was really never their comfort zone.
So all that and plenty more coming up on today's program. But look, I don't want to start the program by looking at the warning signs that are springing up for financial markets around the world. Even late this week, the Tesla shareholders enthusiastically voted for a potential $1 trillion pay packet for Elon Musk. It screams overindulgence. Even though Musk's remuneration is heavily geared to the shareholders' outcome, he needs to grow Tesla almost 6 times in 10 years to get that $1 trillion worth of stock. The sheer scale of it and the risks seem inordinate. And for a company that's grown by tapping the global demand for electric vehicles and via batteries, his future plans pivot to robots and to artificial intelligence.
And things do get kind of wild from an economic standpoint. Because at a certain point, with AI and robotics, you can actually increase the global economy by a factor of 10 or maybe 100. There's not like an obvious limit.
And it's not the only warning sign of indulgence out there. The massive fall in cryptocurrencies, Bitcoin and Ethereum, gives a warning about prices being set for perfection. One of the biggest is the US Federal Reserve being forced to pump $125 billion into the US banks in just 5 days to prevent a liquidity squeeze in America this week. And after the Fed cut interest rates last week, it's now stopped selling bonds into the market, soaping up cash in the system. The US Federal Reserve Chair explained just a little of what's happening when they made that interest rate announcement.
Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard.
But by putting more cash into the US economy, they're trying to basically avert a disaster, especially when many parts of the government there are shut down because of the political impasse in the Senate. Here in Australia, there's no immediate credit crunch. But even our own Reserve Bank Governor, Michelle Bullock, while keeping interest rates on hold for possibly a prolonged period this week, in her press conference, she let us know that she's keeping a watching brief on what's happening in America.
The Fed have got themselves, as I think Jay set out, to a position now where they think their reserves are about as low as they can go without introducing difficulties in the money markets for banks trying to get liquidity. So this is obviously part of their response to do that. I don't think there will be a credit crunch because I think that's exactly what the Fed is trying to avoid, getting some sort of liquidity crunch.
And also watching all of this is our own Treasurer, Jim Chalmers. He gave an overlooked speech earlier in the week to the City 50 Australian Economic Forum about the intensifying competition for capital, for liquidity, if you like. He cited a speech by the former Fed Chair, Ben Bernanke, at a time that the world had too much in savings and too little to invest in.
For a generation, money was cheap and it was plentiful. But 4 shocks in 15 years have reshaped the world economy, driving up the cost of capital and redrawing the global investment map. When Bernanke spoke in 2005, global savings stood at around 25% of GDP. Today, it's near the lowest level in more than 40 years at around 22% of GDP. So in a global economy of around $169 trillion, that's about $8 trillion less than if the world was still saving at mid-2000s levels. There are a few explanations for this. Ageing populations mean households are increasingly drawing down savings rather than building them up. Quantitative easing gave way to quantitative tightening. China's economy is maturing. It's facing bigger structural headwinds and it isn't in the position to be the global provider of capital in the same way that it was 2 decades ago.
Yet this is a time when the world needs more capital and not less to roll out the infrastructure that's needed for the new generation of artificial intelligence. Think transport, health, education infrastructure, even our cities might need to be rethought and rebuilt to cope with that in the future, which might also make you rethink the all-time record share markets here and around the world. So let's bring in our regular panel that looks at the investment markets. Anton Tagliaferro and June Bay Liu are 2 of Australia's most respected investment managers. Anton, the founder of Investors Mutual, remains its investment director. And June Bay Liu is the founder and lead portfolio manager of the boutique investment manager 10Cap, which manages Australia's first long-short ETF, which is going to be launched in just a little over a week's time. So welcome to both of you. I'm so pleased you're here because markets just keep hitting all-time highs. You've had Bitcoin, you've had gold. Come on, Anton, are there red flags out there for you for investment markets?
Look, it's a time, Ross, where markets are being driven by momentum. I think we have a whole generation of investors who are about to learn about that valuation is relevant. So at the moment, many of those markets, Bitcoin, gold, all these AI stocks, rare earth stocks, whatever the trend is in a particular week or two, it's all about momentum. And when that momentum turns, you see these large moves because none of them are based on valuation. So we are coming to a point, I believe, in the next, it's always hard to know when, 3 months, 6 months, maybe next week, I'm not sure, when valuations will matter. They have to matter because the nonsense we've seen in the last sort of 6 to 12 months I've never seen before in my career. I mean, you look at Palantir, which is an AI stock in the US. It's trading on 80 times sales, next year's sales. It's valued at 500 billion US, which is 800 million Aussie. So that's half the Australian stock market capitalisation. So one AI stock trading on 80 times sales is half the market cap of all our resources, all our banks, all our everything, right? So you sort of sit there and go, as I said, it's a momentum-driven market, and I think there's a whole generation of investors who are about to learn that valuations matter.
Okay, so June Bay, you've got the same view because obviously you've invested in some of these situations that have run up pretty rapidly. What's your own view about where valuation sits right now?
Look, in some areas, yes, you do see some valuation issues. We talk about the multiples and others. However, the AI trend itself, my view is that it's got a long way to go. We are seeing a lot of, the difference between the tech bubble and this is now. Tech bubble is a lot of random companies throwing money at new ideas that doesn't have proper user case. And now, AI, we're using it. We use 3 different language models and trying to see the thing. And we're getting efficiency. And then the next level up is actually using agentic version and to really help you to find, strategize your business across every industry. I was actually just in New York a few weeks ago. I saw all the big banks. I saw the Goldman Sachs, the JP Morgan, Wells Fargo, and KKR and the private equity and everything else. Yes, certain areas of the market, they talk about private credit. It's growing really fast. They cover frauds, things that are happening over there. But in terms of market dynamic, Goldman Sachs said they are advising about $1 trillion of asset for the next little while. And that's a pipeline for coming to market, mergers, acquisitions. There's a lot of activity coming in 2026. So the market is actually looking very healthy. Yes, there's a bit of volatility more recently because certain areas is becoming more expensive. But I think majority marketplace actually looks pretty good. We talked about Australian market. Actually, it doesn't look too expensive.
Okay, so I'll go back to you, Anton, because this is whether this is a new paradigm for investment. Every time anybody says that, it sort of falls over the markets. I'm just wondering whether you sense that there is something new coming as a result of the opportunities from artificial intelligence in particular. We've seen the run-up in the chip stocks. We've seen the run-up in the data centres. It's what happens next to all of that.
Ross, a lot of money. I mean, you look at the hyperscalers in the US, the Metas, the Amazons, the Oracles, they're spending hundreds of billions now a year on data centers. They're not sure if they'll ever make a return on what they're building today. So at the moment, we have central banks pumping in, or governments printing money, giving handouts. We've got all these hyperscalers spending hundreds of billions a year on data centers. It's a one-off, essentially, but they don't know. We've got private credit funds with very loose credit policies, lending money everywhere, and I think we're beginning to see some of those things come home to roost. So we do have this wall of money hitting markets, and we are seeing, some irrational behaviour in many parts of the market. So at some point, as I said, we have to have a correction. It can't go sort of momentum always, and valuations will matter. I think where I do agree, funny enough, there are stocks where there is some value, because if they're not doing well in this particular moment, they get slammed. If they're earning on an earnings upgrade like Wesfarmers, they go to $96 or something ridiculous. But as soon as you lose that, it comes right down. So you do have this market of extremes. So there is value in some of those out of favour stocks. But then on the other hand, there is so much hype in many of these other sectors.
Well, Junbei, you famously run long-short funds, so you can as equally go short as you can long. What's your own sense right now? Are you looking for more short opportunities to be able to profit if prices fall, or are you still on the long side looking for the upside in many of these situations?
You're absolutely. So with our long short, we actually move from places to play where we see the opportunity, things will fall. So valuation part is the expensive company is where we do find some of those opportunities on the shorting side, because where we, some of those companies, if your earning is not going to meet people's expectations and you're very, very, very expensive, then there's a lot of opportunity on the short side. So that's where we concentrate our ideas at the moment. However, what's interesting though, in the cyclical component of of our market at the moment, because the interest rate cut didn't come through, and then the costs running a bit high, the inflation is running a bit high, and then consumers sort of pause some more. We are seeing a bit of, actually earnings air pocket at the moment for some of the cyclical sides. So we can use those. We can use some of the short in those spaces as well. But these are the side we kind of more think. A lot of those companies, they're cheap enough. If share price does fall, it's probably providing really good buying opportunity, because look, our economy actually doing okay, and these companies, nothing like the valuation stretch that we see on the other side.
Okay, so you say that our economy is going okay. It's only growing at 1.8% per annum at the moment. So we're talking to the banks at the moment. Their costs are growing faster than their sales. We'll talk to Andrew Irvine very shortly. And as a result, their profits are being squeezed. They're going backwards. Now, the banks have had massive run-ups this year in anticipation of interest rate cuts and so on, but it just even strikes me that we're not in a fast-growing economy right now, that we are a bit stuck, and that surely is going to put a handbrake on the earnings that companies in Australia can make.
Yes, look, Ross, and I think we've been talking about the banks being, overvalued for a while. I mean, they're all on a P of 20, which has never happened before. I guess they are benefiting from a situation where at the moment there seem to be zero bad debts, and the economy keeps rolling along, either because of government handouts or government spending or whatever. But look, they don't look very attractive, because, as you're saying, they've had this big re-rating. Their PEs used to be about 14 or 15, they're now on 20 or 25, and their earnings have maybe moved, 2 or 3 or 4%. So that's again, I think that's showing the weight of money argument. Where you have all this money from governments, private credit, whatever. The world is awash with money, and we're ending up with very strange valuations, you know. But I think we're coming close to a time where valuations will matter again.
So, Jumbo, one thing about this, and that is exchange-traded funds. You're launching one, I know, but they chase the stocks when they're going up and they drop them hard when they're going down. Tell me about the fact of being an active manager versus the passive managers who chase it, because many people believe that they actually skew the markets.
So that's the passive ETFs that you're speaking to. What we're launching is the active ETF that chase the actual manager, how we perform. You're absolutely right. So those passive ETFs, they magnify the rise and fall of certain factors, you know, whether it's a thematic, you know, whether it's rare earth and others. Gold, for example, you know, you have a lot of passive flow into it, but the minute that turns, it can create some more significance in terms of the other side. The passive ones absolutely has been the magnification, but active space is what's interesting. It's quite new, and it gives the investors the opportunity to actually buy into the institutional grade fund managers, because previously that's only really available to high net worth, you know, ultra high net worth individuals, because, you know, your unit trust minimum spends like $100,000. So this much, Well,
I'll tell you what, it's going to be fascinating. And in the next couple of few weeks, we'll just get you back again just to assess where the markets have gone, whether we're at a tipping point, or whether indeed there is more to run in this astonishing boom. Many thanks for your time. Anton Tagliaferro from Investors Mutual and Jumbo Liu from 10Cap.
Thank you.
Thanks, Ross.
Well, from there, we're going to go to Australia's biggest business bank, the National Australia Bank. Like Westpac, which released results earlier this week, and also Macquarie on Friday, it's clear that expenses at our biggest institutions, as I was saying, are growing faster than their income. And as we've just been discussing, unless Australia's economy can grow faster, then the nation and its living standards ultimately have to grind to a halt. So this week I sat down with the NAB's Chief Executive Andrew Irvine, who's been in the CEO's seat there for around 18 months, having previously run its highly profitable business bank.
One is you've got to grow revenue faster. And I think what's pleasing is that in the second half of the year, we saw a real increase in momentum in all of our business, and particularly in our business franchise across both our corporate and institutional bank as well as our business and private bank. So that's really pleasing. We're growing there at the fastest rate in, I think, 3.5 years. So that's one, you've got to grow your top line. And then the second thing you've got to do is manage your costs well. We've traditionally done that as a bank. We're a pretty efficient bank. Obviously, in the last year, we had to deal with a problem with regard to colleague payroll that created elevation in our costs. We're hopeful that we can get that done and get back to a position where we're growing revenues faster than costs.
Okay, so broadly though, inflation is still an issue in Australia. So that means those pressures on payrolls, those pressures on costs, they're not going away anytime soon. So the question is, can you actually control those costs, or at some stage do you have to make some hard decisions?
Well, I think we have to control the costs that we can control, and we're looking at doing that. And so, you know, managing staffing numbers, working hard to deliver recurring productivity so that you make yourselves more efficient, improving processes and practices. And we're really leaning into that. You know, we've also got AI coming that I think is going to help our colleagues to automate low-value work and focus their time on higher value work that our customers appreciate.
Do you think there'll be many job losses as a result of AI, not just in the National Australia's Bank specifically, but in the broader community?
Look, I do think over time, as the technology matures, that there will be some job impacts, but we're in an economy that needs more jobs. We need more construction workers. We need more workers in our care economy. And in the banking environment, we want more bankers. We want more branch staff. I'd love to open my branches longer. And so you'll see, I think, a shift in the type of work that there is, and there may be some ups and downs, but I don't think we're going to have enormous job losses at scale in this country.
And what about NAB specifically? Can you see efficiencies that will come from the AI? Do you think your headcount in, say, 5 or 10 years' time will be lower or greater than what it is today?
I think there'll be certain types of work, operational work, where we'll have a lower headcount. And I think that's a good thing. And you know, to the extent we can then, it allows us to hire more bankers. We want more home lenders. We want more business bankers all over the country, you know, so that we can shift the mix of our workforce. I think that's great. And if we can safely run the bank well and continue to grow and deliver for our customers with fewer people, then that's something that, I would be good with. But we just got to make sure that we're running the bank well consistently over time.
Okay, so you did speak at the very beginning about growing the top line faster than what the expenses are growing. As I said, that's hard with inflationary pressures right now. It's also hard when our economy is right now only growing at an annual rate of under 2%, 1.8%. So how do you grow a bank faster when the economy is basically growing at just about half of its long-term average?
Yeah, well, we actually think we're seeing a little bit of an acceleration, Ross. We expect growth this year to be 2% and next year 2.3%, which, as you say, is about the trend levels of growth that the country can safely generate without triggering unnecessary excess inflation. And, within that, we're seeing credit growth increasing pretty materially. We expect business lending to increase 7.5% next year at the system level. If I turn to housing, something more like 6%. These are good numbers. But what Australia needs to grow at a faster rate is more productivity. Sure. So we need more construction, more dwellings, so that we can enable the dream of home ownership, as well as bring more migrants to our country. We need energy prices to stabilise so that we can have affordable energy and encourage more manufacturing on our shores. And then we need to take advantage of AI and all the benefits that will bring. And if we do those things well, and also get rid of red tape and what makes it hard to do business in this country, hopefully we could increase our trend rate of growth to something more like 3%, which is where we would all want it to be.
And how confident are you that the government, this government, any Australian government, can achieve those ambitions of reducing red tape, taking away impediments to competitiveness to try and boost that productivity?
Look, I think it's been hard, and we've been having this productivity conversation for at least the best part of 10 years. What I would say is that we have a government now that understands the gravity of the problem and the opportunity we have. I think the question now is going to be, can we grasp it? It's not just government that has to do it. All of us need to. Banks and corporations have a role to play as well. But I tell you what, it's really important that we grasp this, because if we don't, it's not certain that the last 100 years that Australia's had, where we were one of the best places in the world to live and work, will be repeated over the next 100 years.
It's that serious, you think, because Australia right now has got to improve its competitiveness, improve its productivity to try and drive more of that wealth back to Australians rather than driving that wealth offshore?
For the last 100 years, every parent could comfortably say that their children would live a better quality of life than they did. And that is at risk right now. We cannot with confidence say that our children will have a higher quality of life than we did. And that's what this is all about.
Okay, then take me to your business bank. You are the biggest business bank in Australia. It is the most profitable area of banking right now to do business. Much more profitable than home loans, where there's white-hot competition. But there's also competition in business banking right now. To protect your lead in that area, do you also need to sacrifice some margin to get the business across the line?
Look, we've been competed against in this space for as long as I've been in Australia. I remember coming here 5 and a bit years ago and being holed up in hotel quarantine just down the road here in Sydney and reading newspaper articles about how others were coming after us in the business bank. And, in the last year, we grew market share in business lending as well as in business deposits. And we were the only big bank to grow share in both lending and deposits this year. And we did that while holding margins steady. And I think that's been a highlight for us and shows good execution. What it means is that we've got to continue to be there for our customers, give them good service, lend them money when they need it, so that they continue to want to bank with us. And that's what this is all about. And we're going to continue to work hard to keep the trust of our customers.
And having run that business bank and having been close to a lot of those business customers, what are those, especially the big business customers that you deal with, what are they saying about Australia's competitiveness right now and their preference for leaving their capital in Australia versus taking it overseas, particularly to the United States?
Australia's got lots of opportunities for growth. You know, I've been out the country recently talking to customers overseas, particularly in Asia. What you're seeing is investors, in some ways, taking money off the table from the US. And so they've got to actually then deploy that capital somewhere else. And one of the places that they're looking to deploy capital here is here in Australia. They like our rule of law, they like our English language, they like the minerals that we have, the energy opportunities we have, and our property market, both residential and commercial. So, you know, Australia is an attractive place for capital to invest, and we need to continue to be that, so that more capital wants to come here to our shores.
Just to finish up, you were the subject of some headlines earlier this week about this year, about your own personal entertainment, the way in which you go about your business. Does that hurt you as an executive? Does it change the way in which you operate? Because these things do get very personal. I must admit I defended you because I think some of these allegations, they were almost indefensible in some ways. There was nothing you could really say. Does it change your behaviour, do you think?
Oh, look, I was probably a bit more judicious in where I was and who I was seen with. But look, at the end of the day, I run the business hands-on. I want to be with our customers so I understand them, understand what's making them tick, and I want to be there helping my bankers. So I don't make any apologies for that.
It still hurts though, doesn't it?
I'm a human being, and, it just is what it is. Just got to get on with it.
Andrew Irvine, many thanks for your time.
Thank you.
Well, coming up after the break, Australia's biggest oil and gas company, Woodside, its chief executive, Meg O'Neill, is keen to keep it as a genuinely Australian company, even though she concedes many of its biggest opportunities in future are overseas. Thanks for being with us here on Business Weekend. Well, this week, James Hardie shares were smashed on the stock market after reports that it was about to be taken out of key indices in its quest, without shareholder approval, it should be said, to move its stock market listing to America. And the temptation to shift to America must surely be there for more Australian companies. The capital markets in America are deeper, the domestic market many times larger. Energy prices a third what they are here. Corporate tax rates as well are much lower. An obvious company to move, in my opinion, is Woodside. Our biggest oil and gas company is now truly a global business, with big operations in Louisiana, the Gulf of Mexico, and in Mexico itself. Its project approval time is much faster elsewhere than it is here in Australia, where its giant Browse field in WA is still caught up seeking environmental and regulatory approvals. Well, earlier this week, after its Investor Day, I sat down with its chief executive, Meg O'Neill, and she explained why she still wants Woodside to be firmly keeping its base here in Australia.
So we've been on a journey the past few years making decisions that are going to transform the company. Between 2024 and 2032, so an 8-year time period, we're going to increase our production by 50%, increase our operating cash flow by more than 50%, and that will give us the capacity to increase our dividends to shareholders by 50% per share, with money left over to either continue investing in future growth or support our shareholders with further returns.
Because I would say that that is an unusual resources company. In history, resources companies held onto their capital because they didn't know where the next bunch of capital was coming from and paid very small dividends. You've taken a different path here to pay more out to those shareholders. Why have you done that?
So Woodside has always been a significant dividend payer. The last 12 years, we've paid 80% of net profit after tax to our shareholders. So once we started up the Pluto LNG project, we were at a point in time where we had a lot of cash flow coming in, and we said, look, we've got to reward our shareholders who stuck through us in these very capital-intensive construction phases that we were in. Really impressively, we've been able to keep up those high returns in the capital-intense period that we're in now. And we know our shareholders are counting on us to continue returning those dividends. Our Australian dividends love the franking credits that we return. We know that is highly valued, and it's inefficient for us to keep them. So we want to get them in the hands of the mums and dads who count on Woodside.
Okay, so it just also strikes me that you are now one of the largest oil and gas companies in the world, energy companies in the world. Why would it not be better for your company to be based in the United States, where the regulatory environment, the capital markets are richer? All of these things seem to favour your company as compared with Australia. Why stay here?
Look, we're a proudly Australian company. You know, this is where we were born, in the town of Woodside, a little bit more than 70 years ago. We've built our business in Western Australia, have a material business in the Gippsland as well, so this is home for us. That said, we're still able to access those great opportunities in the U.S. So some of our significant growth opportunities are investments in the U.S. We're able to access the capital market. We have great access to the bond market. We raised $3.5 billion in the U.S. bond market earlier this year. So the fact that we're Australian listed isn't an impediment from taking advantage of all those things that the U.S. offers today.
Okay, so the US offers all of those advantages, but there is even the regulator this week raising issues about whether Australia's capital markets are competitive enough, whether the technology is kept up. All of these things would otherwise be obstacles to businesses such as yours remaining an Australian listed company.
Well, again, we've got such a strong Australia shareholder base. We've got a lot of, and our revenue right now is 75% Australian. And even as our business transforms, Australia will still be an important part of the market for us. So again, we can get all the good things out of the US whilst remaining ASX listed.
Okay, so then tell me about the Australian regulatory scheme for an energy company such as yours. It's been notoriously slow to grant you approvals for the extension of the Northwest Shelf, of even Scarborough. Browse in particular is a field that really is still waiting to be developed. Is there a danger that Australia leaves valuable hydrocarbons in the ground because government's just simply not fast enough or astute enough to be able to develop them?
Look, we've been really clear about a couple of things. One is the importance of gas in the energy system, both in Australia, and the importance of Australian gas for our customer nations abroad as they think about energy security, national security, and decarbonisation. Today we talked about the role that LNG could play to help displace coal in the world's power generation mix. So gas is needed. I think we've been moving the needle on people understanding that gas will be important in Australia. You know, if we think about how to decarbonise Australia, we need to get rid of the brown coal. And replacing it with renewables and gas is the low emissions way to do that. That keeps the lights on for everybody. So I think we're starting to make headway. But that said, the regulatory environment continues to be very challenging. Northwest Shelf life extension, we were very pleased to get that approval. But there's been challenges along the way. We're in court on multiple matters related to some of the developments we want to progress, including Northwest Shelf. Our message to government is we've just got to speed things up. It's too difficult to invest here.
Okay, so it's too difficult to invest here. That's not a message any government would like to hear, I would imagine. And other places that you have investments, in Africa, in the United States, in Mexico, you know, even in Korea you're doing some work as well. These environments, these jurisdictions seem to be more welcoming of your capital, of your presence.
Look, everywhere we go, the governments want to ensure that a company like ourselves is doing the right things, that we're paying taxes, that we're investing in community, that we're creating jobs. We've done all of those things for 40 plus years here in Australia. We're doing those things now in places like Mexico and Louisiana. We would love to continue doing that in Australia. We are with the Scarborough project. We'd love to do that with Browse. But again, you know, governments will make choices. They'll make policy choices about where they want their nations to head. Perhaps the encouragement for the government here is if we think about things like critical mineral processing, you know, reindustrialization of Australia, all of that requires energy, and all of that is going to require natural gas. You've got to have natural gas to have the heat required to process critical.
Artificial intelligence is the obvious one to talk about.
Artificial intelligence, yes. So, you know, if we're going to unleash the technology capability and the potential that this nation has, we've got to be able to have that sovereign AI capability, all of which requires power at large scale.
So you're already building one ammonia plant, one large ammonia plant, which is fairly close to being completed. Right. So is it tempting for a business such as yours to do more of that, to add value to your gas so you can actually send it as gas through a pipeline, create LNG and ship it around the world, or create products including ammonia and hydrogen? Because that sends you right up the value chain in terms of your product, doesn't it?
Sure. So we've spent a lot of time on our what we call our new energy strategy, where we've looked at what are alternative molecules that have lower carbon intensity when our customer uses them. and hydrogen and ammonia fit in that space. So whilst ammonia has many uses today, fertilizer, explosives, the opportunity we're pursuing is the use of ammonia for energy, either in power generation or marine transportation. There are some good positive policy signals out of places like Europe, as well as Japan, Korea, Singapore. But we need to make sure that we're disciplined with our investment dollars. And the markets for lower carbon ammonia are moving a little bit more slowly than some of those nations would have suggested a few years ago. So we're laser-like focused on demonstrating value from this Beaumont New Ammonia project that we acquired last year, making sure that we've got high-quality customers when we've got that low-carbon ammonia to sell. And we'll be very disciplined before we start further expansion in that space.
So just take me finally to Bass Strait. And I want to go in terms of you acquiring the interest in Bass Strait, where Woodside first looked for oil and gas, that now, because of the deal you've done with ExxonMobil, you get control of it. You can start to explore again. Is there much gas left there?
Yeah, so we're very excited about Bass Strait. Through the BHP Petroleum merger, we have that 50% stake. And one of the things that we've seen, and our team that's been working it has seen, is that there are some opportunities to squeeze a bit more gas through that asset. So when we negotiated the agreement with ExxonMobil, we said, look, we've got to have a joint venture agreement that allows us to pursue those opportunities, even if ExxonMobil isn't as interested.
So is this gas that's known to be there? Is this gas?
So there's about 200 petajoules of gas that has been discovered, just not developed. So we're excited about those opportunities. And I'm really excited about the ExxonMobil team coming across. So we'll take over operatorship next year, and about 600 people will come join the Woodside team. I know they've got things up their sleeve. I know they've got opportunities, and so we look forward to having the new team on board to squeeze maximum value out of this asset that we can.
Okay, so I seem to remember that Bass Strait was due to run out early 2030s, 2032, something of that nature. How long do you imagine with these extra resources you can keep Bass Strait running and keep the gas going into Victoria via the Longford plant?
Yeah, look, I'll have to give you a date once we get our hands on the tiller.
Yeah.
But cautiously optimistic, as I said, 200 petajoules in the 4 known opportunities, and then we'll see what the team is able to unlock by hard work, engineering know-how, and that creativity.
So you've developed this story, the narrative about Woodside and its future. Does it sometimes disappoint you that politicians and or others in Australia don't understand that story well enough?
Well, look, I think there's an opportunity for us to make sure that we are effectively telling our story. And hopefully you've seen some of the ads that we've been running talking about the role of natural gas in the power sector, in the manufacturing sector. We sell natural gas to miners, to mineral processors, to smelters. All those sorts of businesses that need our product to be profitable in their own spaces. So we're spending a lot of time on this communication journey to, again, help politicians and the ordinary citizen understand why natural gas is so important.
Meg O'Neill, always good to chat to you. Many thanks for your time.
Thank you.
After the break, more companies are choosing to remain private rather than listing on the public markets with the extra disclosure obligations. The ASX is also under investigation by our corporate cop ASIC. So we speak with the boss of an alternative exchange that's created a market for shares in private companies. It's great to have your company here on Business Weekend. Well, the decision by the Chicago-based derivatives network Cboe to sell its Australian stock exchange is a genuine blow for the corporate regulator ASIC, which is trying to improve competition in Australia's listings market after a series of embarrassing blunders by the local stock exchange operator, the ASX. Since launching back in 2011 under the brand name Chi-X, Cboe now holds around 20% of market share in Australia's equity trading. Earlier this week, the ASIC chair, Joe Longo, spoke at the Press Club in Canberra, where he discussed the rise of private credit and private markets here in Australia. The clear point is that businesses are choosing to stay private for longer to avoid the arduous continuous disclosure laws that ASX-listed companies have to comply with. But to trade shares in private companies, well, there's another alternative. The platform, FCX, is owned by FinClear, and it's watching closely the brawl between the ASX, Cboe, and the regulators. Ed Boyd caught up with FinClear's chief executive, David Farrell, earlier this week.
Yeah, Ed, look, a good question, and I don't think it's worrying at all. look, SIBO, and they're very clear in their announcement, have a clear strategy for leveraging their core businesses, and their core businesses are derivatives and futures markets in the US, and that's where they're focusing. This was always a bit out of their comfort zone potentially. So I don't see it as being a surprise. I don't really see it being worrying. It's actually a good business. They've got to some critical mass, 20%. I see it as an opportunity for a bit of a refresh and for someone to come in and really provide competition to the ASX.
Yeah, it was previously owned by private equity. Do you think, are you hearing anything that private equity might be interested, or?
Look, I guess that's, again, a great question. I don't know there. The obvious acquirer probably would be another international exchange, potentially. Look, you know, SIBO were never natural in terms of being a listing exchange because it's not really what they do globally. Like I said, they're a derivatives and futures exchange, and so listing companies was really never their comfort zone. But another international listing exchange would be probably the ultimate or the obvious owner.
SIBO did a lot of hard work. They received approval from ASIC just last month. It's now able to list companies. They can now compete with the ASX. You've been through the approvals process with ASIC as well over the past few years. I mean, how strenuous and rigorous is that regulatory process?
Oh, look, I'd say we had a pretty good experience with ASIC. They took what we call a very proportionate approach to admitting us. That being said, it was still long and still quite rigorous. And obviously SIBO have been through that same process as well.
One of ASIC's goals is to improve, you know, competition in the markets. Are they doing a good job?
Oh, look, I think you know, Joe gave a very good address yesterday at the National Press Club, and certainly they're trying. When it comes to, and I'll talk to my expertise, equity markets. The limiting factor in Australia has always been that we're constrained to one big counterpart here, not just as an exchange, but as an infrastructure provider, a back-end clearing and settlement provider. You know, that's where the complexities lie, and not necessarily around competition at the front end. Because there are other exchanges, there is competition there already. It's really the back end that needs to be focused on, and not focusing on traditional clearing and settlement, but focusing on how technology can move into this space, rather than taking a traditional approach.
So how do we encourage that?
Well, I mean, I'll quote Joe, I think from yesterday, and if you don't mind, I'll just pick on what Joe said. In the past, we've tended to talk about public and private markets as if they were totally separate. Mm-hmm. But what our work is showing is convergence, a shift from public or private to a single concept, the concept of the market, a shift that will only accelerate with new technology. Joe then went to go on and talk about tokenisation of securities, atomic real-time trading and settlement. And that's what we've been focused on very much with FCX over the previous years. You know, we are the first regulated market using tokenisation of securities and back-end real-time settlement. That is where competition comes in from alternate structures, I think, rather than thinking about traditional structures.
Joe also said the private credit's now 200 billion plus, and private companies are staying private for longer. Are you seeing that, private businesses staying private for longer periods of time?
Oh, without a doubt. One of the big dynamics is companies not wanting to go public. And why don't they want to go public? Well, they become subject to continuous disclosure and the public scrutiny that comes with that. Also got this dynamic in Australia where we have a single listing market, essentially ASX. And if you're of a size and scale that gets into the ASX 200 or 300, it can be a very good experience. Mm-hmm. If you're not, and you're down the bottom end of the 2,000 other odd companies, it cannot be a great experience. And so what we have here is we're starting to see a bifurcation in markets where it's very good to list if you're at the top end to create liquidity and diverse shareholder base. But if you're not getting to that size and scale, there's no other infrastructure, there's no market to support you. And that's really what we're doing with FCX, is trying to build a more fulsome ecosystem to take companies from early stage, mid stage, through to a public listing on the ASX or another public listing. But at the moment, Australia doesn't have a choice. You either fit into that box or you don't fit at all.
Yeah, and as the ASX's reputation's taken a few hits over the past 5 or 6 years, has that encouraged more businesses to go private?
I think it's encouraged businesses to remain private. Look, we come across very good businesses which surprise us the whole time. We're talking about businesses that would be worth many billions of dollars, that would have revenue, of hundreds of millions of dollars. Very successful businesses that people have never heard about, and they have just remained, or they have elected to stay private longer. The missing piece here is infrastructure. They have no infrastructure to sit on. They have no mechanism for a liquidity event away from going to a public market. So there's no doubt companies are electing to stay private longer. The missing piece is having infrastructure and liquidity to give them a similar experience to listed companies.
Last time we spoke was about a year ago, shortly after you were granted a clearing and settlement licence for FCX. How's it been going over the past 12 months?
Yeah, look, it's been really good, Ed. We've managed a few transactions. We had a marquee transaction back in July, August, September for Future Group, Future Super. We managed a secondary transaction for them on platform. Went very well. It was the first time that we used our market licence and our settlement licence in anger, if you want to think about it that way. And we're very focused now on follow-up transactions, but also specifically looking at the fund opportunity. So we think in Australia there's a real opportunity for illiquid assets, unlisted funds, to have an opportunity to use our infrastructure.
And just finally, what is the outlook like at the moment for private investment and private business in Australia? Is it a good time to be there?
So if you're an advisor and you're an investor and you're looking for opportunities, you really don't have too many choice other than start to look at private. And so what we're doing in terms of allowing access into private markets and showing investment opportunities is, we think, very exciting.
David Farrell, Chief Executive FinClear, great to talk to you.
Thanks, Ed. Pleasure to be here.
And that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course you can keep up to date with all the latest business news with our daily program, Business Now, 4:30 p.m. Eastern Time, and also via our website, skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.